Well, now let's move on to talk about selling merchandise. The merchandiser calls its revenue sales. We are no longer going to use the account fees earned, and we actually just call it plain old sales, not sales revenue, but the account title is simply sales. But it is a revenue account. Being a revenue account, it's going to have a credit balance. When do we record sales? Now, at first glance, that seems like a very obvious question, and sometimes it is. If I go into Walmart to make my family's daily run to Walmart, somebody's there every day, Walmart would record the sale when I take my buggy full of stuff and I check out at the cash register and I pay and I walk out the store with the materials. It can get more complicated than that. For example, what if a customer were to call me today and say they would like to have a quote on something they'd like to buy? And a quote is when I simply tell them, here's what I charge you for the item. So they call me today and they want a quote. Maybe tomorrow I call or I email them the quote. Maybe the next day they actually get the info that I sent them. Maybe the following day they call me and say, yeah, I would really like to buy that merchandise. Okay. Maybe the following day I send them the merchandise. We're up to 5 days so far. Maybe the next day they actually receive what I sent them. And then maybe the next day they actually paid for what I sent them. Well, right there, I have just rattled off 7 possible days. So when do we record sales? I'm not going to answer that question really now, but the general rule is when legal title to the goods passes from the seller to the buyer. When legal title to the goods passes from the seller to the buyer, when ownership of the goods changes hands, that's when I'm going to record the sale. Now, we actually won't answer that question anymore today, but it will be the first topic that we talk about next class then. To record making a sale takes not 1 but 2 journal entries, and the entries are for 2 different amounts. The first entry is to record the sales revenue. To record my sales revenue will depend upon how the sale is made. Is it a cash sale? Is it a credit sale? Or is it a credit card sale? Regardless of the method of sale, the amount of this entry is going to be what I am selling the item for, what I am charging the customer for the item. How about if it is a cash sale? I sell merchandise to a customer and they pay me in cash. What do I have more of? Cash. An asset goes up with a debit. What else do I have more of? Sales, which is revenue, and it goes up with a credit. So debit cash to make the asset go up, credit sales to make the revenue go up. What if it is a credit sale? My customer promises to pay me later on. What do I have more of? Accounts receivable. It's an asset, goes up with a debit. And I also still have more sales, and that's revenue, and revenue goes up with a credit. Credit card sales. Talk about now a company who accepts credit card. The money goes directly into my account when I make a credit card sale to a customer. I'm going to debit cash in credit sales. To me, when a customer buys something from me and they use their credit card, it looks just like a cash sale. I debit cash, I credit sales. That's the good part. Because electronically, that money gets transmitted to my checking account immediately. However, there's a drawback, a fee. We're going to assume somewhere between a 3 to 5% fee is generally what is charged them. So, at the end of the month, they're going to come into my checking account and they're going to make a withdrawal for the amount of my fee. At the end of the month, I'm going to make a journal entry that looks like this. I'm going to debit credit card expense, which is just a regular expense to us, and then I am going to credit cash. That makes my expense go up, and that makes my cash then go down. So, from our standpoint, a credit card sale looks just like a cash sale, except at the end of the month, they come in, they charge me a fee. They go debit credit card expense and credit cash. So that's the first journal entry, to record making a cash sale, a credit sale, or a credit card sale. The second entry is going to look the same regardless of how the sale is made. Cash sale, credit card sale, it's all the same. The second entry is to update the inventory. Because if I sell something, what happens to my inventory? I've got less of it. It goes down. Inventory is an asset, and assets go down with a credit. The amount of this entry is how much the item cost me. Not what I sold it for, but how much it cost me. I'm going to credit merchandise inventory to make the asset go down. My debit goes to a new account to us, and that is called cost of merchandise sold. What's important to know about cost of merchandise sold is that it is an expense. An expense. Cost. Doesn't cost sound like an expense? So cost of merchandise sold is an expense. Now, I'll often call that cost of goods sold just because it's a little shorter phrase. So cost of goods sold, cost of merchandise sold mean the same thing. You're welcome to abbreviate those COMS instead of writing it all down. Now, to understand this, let's think back to supplies, because this all gets back to the matching principle. Under supplies, we said whenever we buy supplies, they are what to us? An asset. They only became an expense to us when I did what? Used them up. When I buy inventory, it is an asset to me. Merchandise inventory is an asset. Inventory becomes an expense to me only when I sell it. And when I sell it, it becomes an expense, not called inventory expense, but called cost of merchandise sold. Why is that? In both of those cases, with the supplies and the inventory, it's a matching principle. The supplies became an expense to me when I used them up because that's when they help me generate revenue, and we want to record them in the same period as the revenue. The inventory becomes an expense to me when I sell it because that's when it generates revenue, and we want to have the revenue recorded in the same period as my expense. So it all keeps coming back to the matching principle of recording expenses in the period when they help us generate revenue. So we have a new account called cost of merchandise sold, and what's important is that is an expense to us. Let's do an example. You'll need your calculator out today if you don't have it. We're going to sell 20 lightsabers to Yoda for $350 each. When we originally bought the lightsabers, they cost me $150. So I'm buying them for $150 and I'm selling them for $350. We need two numbers. We need to know in total how much we're selling the lightsabers for, and then we'll need to know how much in total they cost me. Well, how much am I selling them for? How many did I sell? 20. And I'm selling each one for how much? $350. So what is my total revenue going to be? Well, $7,000. $350 each times 20 of them says that my revenue is $7,000. Secondly, we need to know how much did those lightsabers cost me. Well, again, I sold 20 of them. Each one cost me how much? $150. 20 times 150 says that they cost me then a total of $3,000. Those are the two numbers we need. Let's record making the sale. First off, let's assuming it was a cash sale. Now look at your handout for a minute if you would. Do you see right where I say assuming it was a cash sale? You see that? You see the journal entry box below there? It's got several lines on it, doesn't it? We're going to make two journal entries and they both will go in that same box. Okay? So we're going to have a total of a debit, a credit, and a debit and a credit all go in that same box there. All right, what do I have more of? What's one thing? More cash. Cash is an asset. Assets go up with a debit. We're going to debit cash for $7,000. What else do I have more of? I have more sales. Sales is revenue, and revenue goes up with a credit. What do I have less of once I make the sale? I have less inventory. Part of it's gone. Now, don't write quite yet. Inventory is what? It is an asset. We have less of it. We're making it go down. How do assets go down then? With a credit. Now, we know we got to write debits on the first line, so skip a line, and then we're going to have my credit to merchandise inventory. Why? To make the asset go down. Now, when I bought the inventory, it was an asset to me, but when I sell it is when it becomes an expense. So we have more expense, but we call that expense cost of merchandise sold. Cost of merchandise sold. And you're welcome to abbreviate that COMS. COMS. So we have less inventory, an asset goes down with a credit. We have more cost of goods sold, that's an expense, and it goes up with a debit. How did I do on that sale right then? I think I did real good. How much did I make? $4,000. I sold it for $7,000 and it cost me $3,000. I made a profit then of $4,000. I want you to see what good matching we have. We have the revenue recorded in the first entry of $7,000. That was my sales. We have the expense, the cost of goods sold, recorded in the second entry. How about if this had not been a cash sale, but it was a credit sale? Customer promises to pay me later on. Do I still debit cash? No. What do I have more of instead? Accounts receivable. Good. Do I still credit sales? Yes. Do I still debit cost of goods sold? Do I still credit merchandise inventory? Yes. So if it is a credit sale instead of a cash sale, the difference is my debit goes to accounts receivable then. If it's a cash sale, that debit goes to cash. So the only difference between the two is that initial debit, the $7,000 debit. Well, let's do another example. This time, Yoda pulls out his intergalactic bank Visa card and pays me with a Visa card. A credit card sale to me looks just like what? A cash sale. It looks just like a cash sale. So we're going to debit cash, credit sales, debit cost of goods sold, credit merchandise inventory. Exactly like a cash sale. That's the good news. The good news is that I get my money right away, right? That's good news. And if that's the good news, you know, there's also got to be some bad news. The bad news says at the end of the month, Visa is going to come in and charge me a fee. I said in this case it's going to be a 3% fee. 3% times 7,000 says how much of a fee are they going to hit me up for? 210? What do I have less off? They're going to go to my checking account and pull the money right out. So what do I have less off? Less cash. What do I have more of? An expense. And we're going to call that expense credit card expense or credit card fee expense. Either one would be good. We have less cash, an asset goes down with a credit. More credit card expense, and expenses go up with a debit. So the good news is I got my $7,000 right away. The bad news is they charged me $210 for that. Let's talk about sales tax. And this one's already filled in on your handout. You don't have to fill it in, but let's just think about it here. Let's suppose I make a sale, $100, and I collect 8% sales tax. Am I just going to collect $100? No. How much would I collect this time? 108. 100 for my sales and 8 for the tax. So I would debit cash or accounts receivable, either one, for 108. How much of that is mine to keep? 100 of that's mine to keep. Okay, so I would credit sales for my revenue, which is 100. How about that other $8? The customer gave me $8, and I need to send it into the government now. So I have some money that belongs to the government, belongs to someone else. What do we call it when I have money that I owe to someone else? Some sort of a payable. And we're going to call that sales tax payable because that's what I owe to the government now. So that's not my money to keep. I have an obligation to send it to the government. Now there's another part of this I don't have on the handout, but let's just think about it. At some point at the end of the month, I need to take my $8 and send it into the government. Pay them $8. What do you think my entry is going to look like when I pay them $8? What do you think I'm going to debit? When I send them that $8 that I owe them? Sales tax payable. Why? To get that liability off my books. Just like paying an accounts payable. It's just sales tax payable. I debit the liability and then I would credit cash when I actually pay it then. Let's do an example. When we sold the lightsabers to Yoda on account for $7,000, we had to collect 7% sales tax. So we had sales of $7,000. The items I sold cost me $3,000. How much sales tax will she collect when she makes that $7,000 sale? $490. Good. $7,000 times 7% says we're going to collect $490. So how much in total does my customer owe me now? Good. $7,000 for the stuff plus $490 for the tax. I'm going to make a debit for $7,490. What account should I debit? We made a sale on account. Accounts receivable, we need to make the asset go up with the debit for the total of the two, $7,490. How much of that is revenue to me? $7,000. I'm going to credit sales in for $7,000 to make my revenue go up. How about the other $490? Is that my money to keep? No, I owe that to the government. So my credit goes where? To sales tax payable. I have a liability, an obligation. I owe that money to the government. Now, sometimes I get students who throw some accounts in that I never taught them. That never works well. But one account sometimes they use is called sales tax expense. Is this an expense to me, the seller? No. Who is it an expense to? To the buyer, the customer. Exactly. This is not an expense to me. I'm just really the conduit. I collect it, and I send it into the government. My second entry is to update the inventory. I have less inventory, and I have more cost of merchandise sold then. So all we change is the first entry, not the second entry. Sales discounts. We talked about purchase discounts before. Remember, purchase discounts is when I bought merchandise and the person I bought them from offered me an incentive to pay them early. Okay, why is that? They needed their money. They needed to pay their bills. Now, we're going to talk about sales discounts. Now, a sales discount and a purchase discount really are the same thing, but from the opposite party's perspective. If I offer you a discount as an incentive for you to pay me early, you would call that a purchase discount, but I would call it a sales discount. So what is a sales discount? That's if I sell merchandise to a customer on account and I offer them an incentive to pay me early. Why offer a sales discount? Well, I need my money now. I need to pay my bills. I need to pay my employees. I need to buy more merchandise so I can sell it then. So a purchase discount to the buyer is a sales discount to the seller. It's the exact same transaction. How do we account for sales discounts? Well, do you remember with purchase discounts we said we would record the purchase assuming we were to take the discount, so we would record it at the reduced price? We're going to do the same thing here for the sales discount. We are going to record the sale at the reduced price the customer would pay me if they took the discount. So this is going to impact the amount at which I record the original sale. This one, I've already filled the numbers in on your handout. Let's just talk about it. What if we make a $100 sale, 210 net 30? It means the customer can take a 2% discount if they pay within 10 days. Otherwise, they've got to pay the full amount on day 30. So if they take the discount, they would save 2%. 2% of 100 is $2. 100 minus 2 says they would pay me $98. My journal entry to record making the sale would be a debit to accounts receivable and a credit to sales, but now it's for 98, not 100. 98, not 100, because 98 is the amount they would pay me if they took the discount. Now the second journal entry doesn't change, so debit to cost of goods sold and credit to merchandise inventory here. How about when the customer pays me? They're going to pay me on day 10. How much are they going to pay me? 98. So my entry then would be a debit to cash to make the asset go up and a credit to accounts receivable to make it go down. Let's do an example. We sell 3 droids to Java on account for $2,500 each. Now when we bought the droids originally, we paid $1,000 for them. Terms 115, net 60. How much in total did Leia sell the droids for? $2,500 each times 3 says my total revenue $7,500. What percent discount can Java take if he pays us within 15 days? That means he can take a 1% discount if he pays within 15 days. Well, 1% of $7,500 says that would let him save how much? $75. So how much would he pay? Well, he owes me $7,500, but he gets to save $75. Says he would then pay me $74.25. And that is the amount at which I'm going to record the sale now. Not $7,500, but $74.25. So now when I record the sale, I'm not going to record it for $7,500. I'm going to record it for $74.25. At what amount are we going to record the cost of what we just sold? How many items did we sell? Well, we sold 3 of them, and each one cost me $1,000 each. So my total cost then would be $3,000. Let's make the journal entry then. We've made a credit sale. What do I have more of? Credit sale, accounts receivable, but my debit to accounts receivable is not going to be for the full $7,500. It's going to be for that less the discount, $74.25. What else do I have more of? Sales. We have less inventory. Inventory is an asset, goes down with a credit. It becomes an expense to me when I sell it, so I have more cost of merchandise sold. So I'm going to credit merchandise inventory to make it go down by the $3,000, what it cost me. I'm going to debit cost of goods sold to make the expense go up then. So this is just like what we did previously to record a sale, the only difference being the amount at which I record the sale. How about when the customer pays me on day 15? How much should they go pay me? $74.25, right? The $7,500 minus the $75, $74.25. What do I have more of?
Cash.
We have more cash. Asset goes up with the debit, good. And what do I have less of? Accounts receivable. They don't owe me any money, less accounts receivable. An asset goes down with a credit. And what if Java did not pay me on day 15, but he paid me on day 60? How much would he pay me? He'd pay me $7,500, and we're not going to worry about that. We get to skip that. I know that breaks your heart. So we're going to assume they always take the discount. So we will not worry about the entry if they do not take the discount. Let's talk about sales returns. We talked about purchase returns a few days ago, didn't we? Remember, a purchase return is when I bought merchandise, stuff to resell, and I sent it back. A purchase allowance is when I didn't actually send it back, but I wasn't pleased with it, but they just simply reduced the amount that I owed instead, and I kept it. A sales return is when I have a customer I've sold merchandise to, and they bring it back to me. A sales allowance would be if they didn't physically bring it back to me, they weren't pleased with it, we just reduced the amount that they owed us. We account for them the same. I'll normally talk about returns instead of allowances here. If the customer's already paid me, I give them a cash refund. If they have not paid me yet, I'm going to reduce the amount that they owe me then. So understand that a sales return and a purchase return are both in the exact same transaction, but from the opposite party's perspective. If I am the one returning the merchandise, to me it is a purchase return. To the person I'm taking it back to, they call it a sales return. To record a sales return, well, there's kind of two steps in this process. First off is we have to make a new adjusting entry. Actually, we make two new adjusting entries, and we're going to talk about that first, and then we'll move on and talk about whenever a customer actually brings something back to us. But the first thing we have to talk about is the new adjusting entry. Let me show you the adjusting entries we make first. The first adjusting entry we're going to make is for the amount of refunds that we expect to issue based upon this year's sales. Here's what this adjusting entry looks like. First off, it's a debit to sales. Sales is revenue. Debiting revenue does what? Makes it go down. Now, we recorded selling the items originally. We're sure that people are going to bring part of them back, so we are debiting sales to make it go down, to cancel out that portion that we think people are going to return to us. My credit goes to a new account called Customer Refunds Payable. Now, being a payable, what type of an account's a payable? It's a liability, right? We know people are going to bring merchandise to us. We don't know who's going to bring it back, and we don't know how much each one of them are going to bring back. But we can estimate in total what they're going to bring back. Now, remember, this is an adjusting entry on December 31st, the end of the accounting period. Have I issued these refunds yet? No. So can I credit cash? Well, no, I'm not giving them their money back yet, right? Can I credit accounts receivable? Well, no, because I still don't know who's going to bring it back. All I know is that I'm going to have to issue some refunds. So my credit goes to this liability account simply called Customer Refunds Payable for the amount of refunds I think I'm going to have to issue. The amount, again, is the amount of refunds I expect to issue based upon this year's sales. That will be given to you as this year's sales and a percent, and you'll multiply the two. Why do we debit sales? Well, we credited sales when we made the original sales entry. We know people are going to bring some of that back, so we're canceling out that original entry for our estimated amount. Why do we credit Customer Refunds Payable? We know we're going to have to pay this amount to somebody. We don't know who. We don't know exactly what the amount's going to be, so we're putting it into this temporary liability account where it's going to stay till we actually pay it back to somebody. The second adjusting entry is for the cost of what we expect people to bring back to us. Now, the assumption is there's nothing wrong with it. They just didn't like the color. Inventory is going to go up, right? Now, the problem is, though, do we know exactly what they're bringing back to us? No, because we're just guessing what they're going to bring back to me from this year's sales. So I can't debit merchandise inventory yet because I don't know exactly what they're bringing back. Instead, we're going to debit a different inventory account called Estimated Returns Inventory. It's an estimate because we don't know the amount for sure, and we don't know exactly what it's going to be. But we think they're going to bring back this amount of inventory. My credit goes to cost of merchandise sold. When we originally sold the merchandise, we debited cost of goods sold. We know people are going to bring part of it back, so we need to cancel out that original entry. Therefore, we are going to credit cost of goods sold in this adjusting entry. So look at the entry you just recorded, that one that's going to be a debit to sales. Do Do you see how that's canceling out the original sale? And now we have a credit to cost of goods sold. Do you see how that's canceling out the original cost of goods sold recorded in the sales entry? In the meantime, until we know anything for sure, we've got the customer refunds payable liability account out there and the estimated returns inventory. When we have actual refunds issued, we're going to take them out of both of those accounts. The amount of this entry is the cost of what we expect people to return to us, the cost of the inventory we think people are going to return to us, and that'll be given to you in a problem. Again, why debited estimated returns inventory? We know they're going to bring stuff back, but we don't know exactly what it is, and we don't have it yet, so we can't debit actual merchandise inventory. Why credit cost of goods sold? To cancel out the debit we made to that account in the original sales entries. Let's do an example here. My sales for the year are $500,000. We think customers are going to request refunds of 3% of my sales. We think they will return merchandise to me that cost me $4,000. How much in refunds do you think we're going to issue from this year's sales? 500,000 times 3% is 15,000. So we think we're going to have to issue $15,000 in refunds. Let's make our adjusting entry. Remember, there are two entries. The first one's going to be for 15. The next one's going to be for the 4,000. In the first adjusting entry, we are going to debit sales to cancel out the effect of crediting sales in the original entry. We're going to debit sales to make my revenue account then go down by the amount that we think customers are going to return to us. Because if they're going to return it to us, we shouldn't really call it sales, should we? We should cancel out the sales that we recorded. My credit, well, here's what I can't credit yet. I can't credit cash or accounts receivable yet because I don't know who's going to bring the stuff back. And I don't know how much each person is going to bring back. Instead, I'm going to credit customer refunds payable. And that is the amount I expect to have to pay my customers in refunds. My second entry is going to be for $4,000, the cost of the merchandise I expect them to bring back to me. Now, I can't debit merchandise inventory yet because they haven't brought it back yet. We are expecting them to return $4,000 worth of inventory to me. My debit goes to my estimated returns inventory for the $4,000 cost of what we expect them to return. My credit goes to cost of merchandise sold. We're crediting cost of merchandise sold to cancel out the debit we would have made to that account when we originally sold this merchandise. So I want you to notice that the debit to sales and the credit to cost of goods sold are both to cancel out the original sales entries. The credit to customer refunds payable is because we don't know who we're going to pay yet, but we know we owe somebody $15,000. Now let's go and think ahead to the next step. When we actually issue a refund to somebody, let's suppose that somebody comes in and they get a $5,000 refund. What do you think should happen to the customer refund payable account once we actually pay $5,000 in the refunds? It should go down. So when we actually pay the refund, we're going to make customer refunds payable account go down. How about the estimated returns inventory? That's the account we know people are going to bring stuff back. We don't know who's going to bring back what and what the items are going to be, but this is our estimate. How about when somebody actually brings something back? We're going to need to make that estimated account go down and my regular merchandise inventory go up then. And that leads us to the next entry we're going to talk about. When a customer actually brings something back to me, we will make, again, 2 journal entries. Remember, we made 2 journal entries for every sale? We're going to make 2 journal entries for every return also. The first entry is to record issuing the refund. If they've paid me in cash, I'm going to give them cash back. If we still owe them, I'm going to credit it. If they still owe me, I'm going to credit accounts receivable. The amount of this entry is what I'm going to refund to them, not the cost, but what I'm going to refund to them. If they haven't paid me yet, I'm going to debit customer refunds payable to make the liability go down, and I would credit accounts receivable. What if they have already paid me? Well, my debit doesn't change, but this time I'm going to credit cash because I have to give them their money back. So why are we debiting customer refunds payable? Well, that liability account represents the amount of refunds I expect to pay. When I actually pay a refund, that's going to make the amount I expect to pay now go down. The second entry is to update inventory. Now the assumption here is that the customer brings something back to you. There's nothing wrong with it. It's not defective. It's not damaged. They just don't like the color. Or it may be something else. But the point being, we can resell it to another customer. So what happens to my inventory when they bring something back to me? It's going to go up. I have more inventory, so I'm going to debit merchandise inventory to make it go up. My credit goes to that estimated returns inventory. Remember, that account represented how much stuff we thought customers were going to return back to us, but it was just an estimate? Now that we actually know what they've returned, we're going to take it out of that estimated account and put it into my actual merchandise inventory. Whether or not the customer paid us does not affect this entry. The amount of the entry is going to be how much the returned merchandise cost me. So why debit merchandise inventory? We have more inventory sitting out there on the shelf to sell to the next customer. Why credit estimated returns inventory? Because we now have the real returns on hand. Where estimate goes down, my actual merchandise inventory now goes back up. Let's do an example. We received 2 Jedi cloaks that Jabba returns to us. We originally sold the cloaks to him for $600 each, terms net 30. They originally cost me $250 each. So he's returning them. We're going to give him back $600 each. They cost me $250 each. How much in total are we going to refund to Jabba for those cloaks? $1,200. 600 times 2, $1,200. How much did those 2 cloaks cost Leia originally when she bought them? $500. $250 times 2 is $500. How much profit did I just lose when he brought them back to me? $700. Do you see? We had made $700 profit on that. Now it's all gone. Let's make a journal entry. First off, assuming that he has not yet paid me for the merchandise. Will I give him a cash refund? No, I'm just going to reduce what he owes me. So when he brings the items back to me, my debit goes to customer refunds payable. Remember, we credited that account in the adjusting entry for the amount we thought we were going to have to pay in refunds, the amount we still owed. When we actually start paying those refunds, now that account balance is going to go down. So debit customer refunds payable to make the liability go down. What else do I have less of? Accounts receivable, because they haven't paid me yet. We're going to credit accounts receivable to make it go down. What do I have more of? Inventory. Inventory is an asset, goes up with the debit. I'm going to debit it for the $500 to make it go up. And my credit, to what I think is the trickiest part of this, is my credit goes to the estimated returns inventory. That does what? Makes my estimated amount to be returned go down, because part of it has now actually been returned, and that's why we made the actual merchandise inventory go up. Let's do this example again. The only difference being this time Jabba has already paid for the merchandise. Has already paid for it. Will we give him a cash refund? Yes. Do we still cash refunds payable? Do we still credit accounts receivable? What do I credit instead? Cash. Good. Got to give him money back. Do we still debit merchandise inventory? And do we still credit estimated returns inventory? Yes. The only difference being what? Instead of crediting accounts receivable, now we're going to credit cash. What would be different about a return if, when the customer returned the merchandise to us, the original sale, there had been a sales discount offered? Well, remember, if a discount's offered, we record the sale at the reduced price, assuming they're going to take the discount. So guess what? With the return, we got to do the same thing. So the amount at which we make the first journal entry is going to have to be reduced by the amount of the discount. Let's do our example again. One we did just a minute ago. We received the 2 Jedi cloaks that Jabba returned. We originally sold them for $600 each. They cost me $250 each, but this time the terms of the original sale were $210 net 30. Well, only difference from before, we've changed the terms. How much are we going to refund to Jabba? Well, let's see. How many cloaks did he bring back? 2. Times how much each are we going to give him back? Okay, let's start with the total, 600. Good. So we would give him $1,200 back if there were no discount involved, right? But the discount, what percent discount could he take? 2. 1,200 times 2% says we're going to, $24 would be the discount. So how much of a refund are we actually going to give? Not $1,200. We got to take the 24 off. We're going to give them $1,176 instead. Now, really, everything else is going to look just the same. But instead of being a $1,200 discount, we had to knock off the 2% discount, Because remember, we recorded the original sale after reducing it for the discount, so we'll have to do the same thing with the return. So just like before in our previous entry, we still are going to debit customer refunds payable, we're going to credit accounts receivable, debit merchandise inventory, credit my estimated returns inventory. Now the assumption here, he has not paid me yet. But notice, what is the amount of the first entry going to be? Not $1,200, but the $1,176. The amount he would pay if he had taken the discount. So since we recorded the original receivable and sale at that reduced amount, we have to record the return at that amount also. What do you think is going to be different about this entry if he has already paid me? What's going to be the only thing which is different if he has already paid me? Got to credit cash instead of accounts receivable. Good. If he has already paid me, we got to give him his money back. So everything is the same with the debits and credits except for the credit. Instead of crediting accounts receivable, now I've got to literally give him his money back. I'm going to credit cash.